My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Risk Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Tips to score high. Learn definitions plus diagrams for contracts. Practice one numerical each from forward and futures. Understand hedge logic. Memorize key differences table, forward versus futures, hedgers versus speculators. Prepare a short note on risk types, commodity, interest rate, exchange rate. Unit 3 first important short question is forward contract. Answer. A forward contract is a private agreement between two parties to buy or sell an asset at a fixed price on a future date. It helps in protecting against future price changes. Example. A rice trader agrees today to sell 1000 kilograms of rice to a retailer at 30 rupee per kg after 3 months. Even if the market price changes later, both parties must trade at 30 rupee per kg. Features of forward contract. Customized as per the needs of both parties. Not traded on stock exchanges, done privately. Used to manage risks in commodities, currencies, and interest rates. Why it's useful? It helps hedge, protect against future price uncertainty. Easy tip to remember. Forward is equal to fix the deal today, settle in future. This is a simple tool for managing risk in business. Next important short question is 2 future contracts. Answer. A futures contract is an agreement to buy or sell an asset at a fixed price on a future date, just like a forward contract, but it is traded on a stock exchange. Example. An investor agrees to buy 100 barrels of oil at 6,000 rupee per barrel after 2 months through the exchange. Even if the price changes, the deal is locked at 6,000 rupees. Features of futures contract. Standardized, fixed quantity, quality, and date. Traded on organized exchanges like NSE. Includes margin money and daily settlement, called marking to market. Why it's useful? Used to hedge risks, protect from losses, or for speculation, to earn profit from price changes. Easy tip to remember. Future is equal to traded publicly with rules. Forward is equal to private deal without exchange. Futures make trading safer and more regulated. Next important short question is 3. Commodity price risk. Answer. Commodity price risk is the chance of facing losses due to changes in the prices of raw materials or goods like oil, gold, wheat, rice, etc. This risk mainly affects farmers, traders, manufacturers, and exporters who depend on commodity prices for profit. Example. A cotton mill buys cotton every month. If the cotton price suddenly rises, the company's cost increases and profits go down. This is commodity price risk. Why it happens? Natural disasters. Political changes. Global demand and supply. Market speculation. How to manage it? Use forward or futures contracts to lock prices. Sign long-term contracts with fixed prices. Keep inventory reserves to handle short-term changes. Easy tip to remember. Commodity price risk is equal to profit loss due to price change in goods. It's important for businesses to manage this risk for stable earnings. Next important short question is 4 players in derivatives markets. Answer. The derivatives market has different types of participants, called players, who use it for various reasons like risk protection or profit. Main players. 1. Hedgers. They use derivatives to protect against price changes. Example, a farmer locks in a price for wheat using a futures contract to avoid loss if prices fall. 2. Speculators. They try to make profit by guessing price movements. Example, a trader buys gold futures expecting the price to go up. 3. Arbitragers. They earn profit by price differences in different markets. Example, buying in one market and selling in another at a higher price. 4. Investors use derivatives as part of their investment strategy. Easy tip to remember. HSAI is equal to hedgers, speculators, arbitragers, investors. Each player helps bring liquidity and balance to the derivatives market. Next important short question is: 5 differences between forward and futures contracts. Answer. Forward and futures contracts both allow buying or selling an asset at a fixed price in the future, but they are different in many ways. Feature forward contract, futures contract. Trading private agreement between two parties traded on organized exchanges. Customization fully customized, date, quantity, etc. Standardized by the exchange. Risk high default risk, no guarantee, low risk, exchange ensures settlement. Settlement at the end of the contract daily through marking to market. Regulation not regulated, highly regulated by exchange authorities. Example, a wheat seller enters a forward contract with a buyer directly. In a futures contract, both trade through the exchange. Easy tip to remember. Forward is equal to private plus flexible. Future is equal to public plus safe. Next unit 3. Long questions. First important long question is: 1. Explain the concept of derivatives and types of derivatives. Answer. A derivative is a financial instrument whose value depends on or is derived from an underlying asset. These assets can be stocks, gold, wheat, oil, currencies, interest rates, etc. Derivatives are mainly used for managing risk, hedging, speculation, and arbitrage. Concept of derivatives. Instead of buying the asset directly, you enter into an agreement based on the asset's future price. This helps reduce the risk of price changes. Example, if you expect the price of gold to increase, you can enter a gold futures contract instead of buying physical gold. Types of derivatives. 1. Forward contracts. A private agreement between two parties to buy-sell at a future date at a fixed price. Example, a farmer agrees today to sell wheat after 2 months at 2000 rupee per quintal. 2. Futures contracts. Similar to forwards, but traded on organized stock exchanges. Example, buying a gold futures contract through NSE to lock the price. 3. Options contracts. Give the right, but not the obligation, to buy-sell an asset at a specific price within a time frame. Example, buying an option to purchase 100 shares of Infosys at 1500 rupees anytime in the next 2 months. 4. Swaps. Agreements to exchange cash flows, commonly used for managing interest rate or currency risks. Example, two companies exchange fixed interest payments for floating rate payments. Easy tip to remember. FFOS is equal to forwards, futures, options, swaps. Conclusion. Derivatives are powerful tools used by investors, companies, and banks to manage uncertainty in the market. When used wisely, they help in reducing losses and improving profits. Next important long question is: to examine the utility of forward and futures contracts in reducing the risk. Answer. Forward and futures contracts are important tools in financial risk management. They help individuals and businesses protect themselves from future price changes in commodities, stocks, currencies, interest rates, etc. Utility of forward contracts. A forward contract is a private agreement between two parties to buy or sell an asset at a fixed price on a future date. It is custom-made and not traded on exchanges. How it reduces risk. Helps in locking the price today to avoid future uncertainty. Example, a rice trader agrees today to sell rice after 3 months at 30 rupees per kilogram. Even if the market price changes, the deal happens at 30 rupees per kilogram. This protects both buyer and seller from price risk. Utility of futures contracts. A futures contract is similar to a forward contract but is standardized and traded on stock exchanges. It includes safety features like clearing house, margin, and daily settlement. How it reduces risk. Futures help hedge against price movements in a safe and regulated way. Example, a gold importer buys gold futures to protect against rising prices. If gold prices go up, the futures contract helps cover the extra cost. Key benefits of both contracts. Price protection from market fluctuations. Useful for hedging, reducing risk in business and investment. Better financial planning. Can be used by farmers, traders, exporters, banks, and investors. Conclusion. Forward and futures contracts are simple yet powerful tools to manage future risks. They allow businesses to fix prices in advance, stay protected from market shocks, and focus on growth without fear of sudden losses. Next important long question is: 3. Distinguish between forward contract and future contract. Answer. Both forward and futures contracts are agreements to buy or sell an asset at a fixed price in the future. But they differ in many ways, especially in how they are traded, managed, and used. Key differences. Feature forward contract, futures contract. Trading place private deal between two parties traded on organized stock exchanges. Customization fully customized, amount, date, etc. Standardized, fixed terms set by the exchange. Regulation not regulated, highly regulated by stock exchange and SEBI. Settlement at maturity, end of contract, daily settlement, mark to market. Risk of default high, no guarantee, low, exchange acts as guarantor. Transparency less transparent, highly transparent with public pricing. Liquidity low, difficult to exit early, high, easy to buy sell anytime on exchange. Use case used by exporters, importers, companies used by traders, investors, banks, and speculators. Example. Forward contract. A farmer agrees today to sell 100 quintals of wheat after 2 months at 2000 rupees per quintal to a flour mill. This deal is private. Futures contract. A trader buys a wheat futures contract on the exchange to fix the price. This is done through a regulated platform like NSE. Easy tip to remember. Forward is equal to private plus flexible plus high risk. Futures is equal to exchange traded plus safe plus transparent. Conclusion. Understanding the differences helps in choosing the right contract based on risk, flexibility, and purpose. Forward contracts are suited for custom needs, while futures are better for trading and safety. Next important long question is: 4. What factors do you consider in valuation of future contracts? Answer. Futures contracts are agreements to buy or sell an asset at a future date and price. The value or price of a futures contract depends on several important factors. Knowing these helps in making better investment and hedging decisions. Key factors in futures valuation. 1. Spot price of the asset. This is the current market price of the asset, stock, commodity, currency, etc. The higher the spot price, the higher the futures price. 2. Time to maturity. This is the time left until the contract expires. Longer time is equal to more uncertainty is equal to affects the price. 3. Risk-free interest rate. This is the return from safe investments, like government bonds. Futures price increases if the interest rate is higher because of cost of carry. 4. Storage and carrying costs. Includes storage, insurance, transportation, etc., mostly for commodities. More costs is equal to higher futures price. 5. Dividends for stocks. If the underlying stock gives dividends, futures price is reduced by expected dividend value. 6. Convenience yield for commodities. It is the benefit of holding the physical commodity, like for businesses. Higher convenience yield can lower the futures price. Example. If gold is trading at 60,000 rupee today, and the interest rate is 6% annually, then the gold futures price for 3 months will be slightly higher due to cost of carry and storage. Easy tip to remember. Futures value is equal to spot price plus cost of carry dividends. Conclusion. By understanding these factors, traders, investors, and companies can fairly value futures contracts, avoid losses, and manage financial risks effectively. Next important long question is: 5. An investor buys 550 shares of Satyam at 220 per share in the cash market. In order to hedge, he sells 350 futures of Satyam at 175 each. Next day the share price and future decline by 6% and 3% respectively. He closes his position next day by counter transactions. Find out his profit or loss. Numerical question: hedging using futures. An investor buys 550 shares of Satyam at 220 rupee per share, cash market. Sells 350 futures of Satyam at 175 rupees each, futures market. Next day, share price falls by 6%. Futures price falls by 3%. He closes all positions the next day. Let's calculate step by step. Step 1. Loss from cash market, spot. Bought 550 shares at 220 rupees is equal to 1,21,000 rupees. Price dropped by 6%. New price is equal to 220 rupees. 6% is equal to 206 rupees and 80 paise. Value after drop is equal to 550 times 206 rupees and 80 paise is equal to 1,13,740 rupees. Loss in spot market is equal to 1,21,000 rupees to 1,13,740 rupees is equal to 7,260 rupees. Step 2. Profit from futures market. Sold 350 futures at 175 rupees is equal to 61,250 rupees. Price dropped by 3%. New price is equal to 175 rupees. 3% is equal to 169 rupees and 75 paise. Bought back at 169 rupees and 75 paise is equal to 350 times 169 rupees and 75 paise is equal to 59,412 rupees and 50 paise. Profit in futures is equal to 61,250 rupees to 59,412.50 rupees is equal to 1,837 rupees and 50 paise. Step 3. Net result, hedging outcome. Loss in cash market is equal to 7,260 rupees. Profit in futures market is equal to 1,837 rupees and 50 paise. Net loss is equal to 7,260 rupees to 1,837.50 rupees is equal to 5,422 rupees and 50 paise. Final answer. The investor faces a net loss of 5,422 rupees and 50 paise even after hedging because the fall in the share price, 6%, was higher than the fall in futures, 3%. Easy tip to remember. Hedge is equal to spot loss plus futures profit. If futures move less than spot, hedge reduces but does not fully eliminate the loss. Next important long question is 6. A forward contract on 200 shares, currently trading at 112 per share, is due in 45 days. If the annual risk-free rate of interest is 9%, calculate the value of the contract price. How would the value be changed if a dividend of 22 per share is expected to be paid in 25 days before the due date? Numerical question, forward contract valuation. Number of shares is equal to 200. Current price per share is equal to 112 rupees. Contract period is equal to 45 days. Annual risk-free interest rate is equal to 9% or 0.09. Dividend is equal to 22 rupee per share, paid on 25th day before expiry. We will calculate 1. Forward price without dividend. 2. Forward price with dividend. Step 1. Formula without dividend. We use the formula. Forward price, F, is equal to S times R times T, where S is equal to spot price is equal to 112 rupees. R is equal to risk-free rate is equal to 9% is equal to 0.09. T is equal to time in years is equal to 45/365 is equal to 0.1233. E is equal to exponential constant, use calculator, EX. F is equal to 112 times E0.09 times 0.1233. Is equal to 112 times E0.0111 112 times 1.011 to 113 rupees and 25 paise. Forward price, without dividend, is equal to 113 rupees. 25 per share. Total for 200 shares is equal to 200 times 113 rupees and 25 paise is equal to 22,650 rupees. Step 2. Adjust for dividend. Dividend is paid before contract ends, so it lowers the forward price. Formula. F is equal to SPV, D, times R times T. We must subtract the present value of the dividend. Present value, PV, of dividend. Dividend is equal to 22 rupee per share. Time until dividend is equal to 25 by 365 is equal to 0.0685 years. PV, D, is equal to 22 times E0.09 times 0.0685 22 times E0.006 to 22 times 0.9938 21 rupees and 86 paise. Adjusted forward price. F is equal to 112.21.86 times E0.0111 is equal to 90.14 times 1.011 to 91.15 paise. Total for 200 shares is equal to 91 rupees and 15 paise times 200 is equal to 18,230 rupees. White heavy check mark final answer summary. Without dividend 113 rupees and 25 paise per share, 22,650 rupee total. With dividend 91 rupees and 15 paise per share, 18,230 rupee total.